Welcome to a Wiser Retirement Podcast. We put together a guide with some recommendations to help you focus on being financially fit at different milestones in your life. Some of you may be ahead of schedule, while others may have to play catch up. You can download this guide for free on our website. The link to download Your Path to a Lifetime of Financial Success is listed in the episode description. Or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Michaela Dowdy. Hey, Michaela.
Hey, Casey.
Today we're joined by Tom Townsend of Townsend Realty Group. Tom has been a guest with us on several episodes now. And today we're going to talk about what financial planners wish you knew about buying your first home. So what better expert, no better expert than Tom Townsend?
Well, thank you so very much. I appreciate that. Thanks
Buying
for having me back.
First home, second home, third home, extra home.
Yeah.
Right?
Investment property.
And investment properties. That's right. So let's just start right here, Tom. Let's talk about what's happening in the real estate market right now. I love real estate. I love looking at real estate. But I just pretty much do it from afar, right?
Yeah.
With my Zillow app and my Realtor.com app. And I've just, as a non-expert in this, I've noticed that there hasn't been a whole lot of movement.
Well, you're looking at it from a very regional standpoint.
Very true. Yeah. Well, neighborhood
Yes.
standpoint.
Well, exactly. And that's how you should evaluate real estate, because it is very local.
Right.
And that's the mistake that many people make, is they hear and listen to the national news about real estate and
Right.
what is happening on a national level. But really, in order to benefit yourself, you have to look local.
Yeah.
Find out what's going on. And it can be drastically different from one area to the other.
So Marietta and Canton might be two different things happening.
Or New York and Atlanta.
True. Yeah.
Or Portland, Oregon.
Right.
And Atlanta.
Who wants
Could
to
be
go there?
drastically different.
Well, so many people moving in. I wonder, like, where are they moving from? So some town somewhere has to have a real estate just bust.
Yes. Well, we're seeing a lot of migration across the country.
Yeah.
And actually internationally as well.
I don't think
that's a whole other issue. That's a whole other podcast.
Okay. Well, I didn't think like California was hurting in the real estate market. And all these people are coming from California, in New Jersey.
Yes.
But yeah,
so both coasts, we're seeing both coasts migrating out.
Yeah.
And we're seeing them moving into the Southeast. We're seeing them move into Texas. We're moving a lot of California, Southern California is moving down into Phoenix area and Arizona. So they're seeing a big boom there.
So are there cheap houses where they're coming from?
I don't know about cheap. We're talking California, right?
I'm just trying to figure out where does Michaela, who's we'll say under the age of 25, where does Michaela buy a house? I can't figure this out. That's a long commute from California.
Great question.
Now we're going to get down to it, right? Well, it's tough. Hey, I'll be honest with you. First-time home buyers, Generation Z, if you will, if you want to call them that,
Right.
it's tough.
I mean, it really the last generation, Generation Z.
Is it Generation Z?
It is. Yes, I'm Gen Z.
Okay,
Technically.
Gen Z.
Gen Z.
Yeah.
Do we just start over again? Do we go back
I
to
think
Gen A?
they've started now where it's Generation Alpha, and now they're about to go through the Greek alphabet, I think, is the plan.
How convenient.
I love these podcasts. I learn so much.
Yes.
So let's get back to the real estate market.
But it's tough. Listen, I'm not going to sugarcoat it. I mean, it's rough. It's tough for the younger folks out there that are just getting started in order to find a house. It really
Which pushes more people to rentals.
It does.
And what you're paying in rent, you're basically is a mortgage, which is crazy.
It is. It's actually a little bit more than a mortgage.
Yeah.
You know, and that makes sense if you think about it.
True.
Right?
True. Okay. So
anyways,
I buy a house a year from now. What's your prediction?
yeah, that's a really good question, and I wish we all had a little crystal ball. That would be wonderful.
People do the same thing with me with the stock market, right? So I figured it's a fair game.
But we can do some predictions. You know, I mean,
Yeah.
we see enough. I personally, you may have your own opinion. I think the Fed has made it very clear that they want to squash demand in this market.
And jobs.
They're
Yes,
doing a very
agree.
good job at it. They're
Right.
trying to kill the economy.
Yes, they are.
So who knows where we're going to be? You know, we've got an election coming up. I don't know where that's going to fall. That's going to affect some things.
Yeah, maybe. I don't think there's as much on elections as people think that they are.
Well, people are,
but people maybe in real estate because people feel better about the future because their candidate won. Maybe.
I think it's.
I mean,
people,
Trump Trump was terrible, right?
Yeah.
And there's some sarcasm in that statement.
Yeah.
But if Trump was terrible and Biden was going to save everything, and now look at the markets.
Yeah. Yeah.
So you can't use the same kind of psychology.
All right. Well, here's and we're kind of getting away from the topic. However, people are frozen. People are waiting. So there's not a lot of movement
because there's uncertainty.
Because there's uncertainty in the market. So
Right.
people are, because we have an election coming up, they're just frozen with their decisions. They're not going to make any moves yet
Yeah.
because they don't know. There's that uncertainty that they're running into.
But we're still holding at these high prices. We just stopped climbing.
Yeah.
Correct.
Well, remember, we're talking about supply and demand, just like any other market in real estate. And
Yeah.
when we're talking about local, now we're talking local here, not nationally.
Right. Within
you've got
Metro Atlanta.
Yeah, in the Metro Atlanta area, you've got the supply line, and then you have the demand. And flashback 6 months ago, supply was right here, even, and demand was way higher.
Yeah.
Way high. Well,
You guys will have to tune into the YouTube channel
the
to see his
YouTube channel
hands.
will see, but there's a big disparity between the supply and the demand. Demand is much higher than the supply.
Right.
Rates, the interest rate hike has brought that demand way down, almost even with the supply, but not quite. So where we're at today, there's still a little bit of a gap in between that equalization. We'll see what happens. We'll see if it gets even or even below that. We're just going to have to wait and see.
This is just a theory I have. You tell me if it's true or not. So to get a FHA loan, there's a maximum loan amount. I believe it's around $544,000. It depends on your zip code where you are.
Yeah, and they change it all the time.
Usually goes up,
Yes.
right?
Yep.
So-
As values go up, they adjust it to accommodate folks.
So you could put down 10% and buy a $544,000 house, and you'd be a conforming loan, I believe, thereabouts.
Yeah.
Okay. So if that were to go to 750,
Mm-hmm.
then I could see prices in that market jump instantly to 750.
Yes.
Because you get into jumbo loan, the lenders start crawling all up into your business. Jumbo loan's a little harder to get.
Correct.
Right?
But they just increased the jumbo loan,
The limit. Correct. Yes.
Yeah.
That
So
helps
it's not
too.
a jumbo. You're not into a jumbo until I can't remember what the number is. 7. It's
Okay.
7 something.
So that's my point, is that it's not just interest rates that are holding the market back, but it's also the fact that the lending limit of easy access has been moved as well.
It has, and what you're seeing is more and more lenders come out with different programs because they have to lend money in order to stay in business.
Right.
They're not going to sit on the sidelines and just go, oh, well, it's 7% now. Sorry.
True.
Right?
Yeah,
so they are starting to roll out some products in order to make it more appealing to folks and to lend.
Yeah.
They have to.
So I guess my point in going back to where we are now and with a first-time home buyer, the reason why you can't find a $250,000 house is that $250,000 house has been pushed up into that $500,000-$600,000 range.
It has. Yeah. And I don't, I listen to the experts, and we don't see a lot of pullback from that.
No, there will be no pullback from that.
There are people that are, it's going to be another crash. We're not looking at another crash.
I do not believe that one cent.
I think we're at a new baseline.
Correct.
We might pull back a little bit. You might
Right.
see a little bit of a little pullback from the last crazy 2 years that we've had in appreciation.
Maybe in the $1.6 to $2.5 million range.
Yeah, you're going to see some pullback. There's a lot of buyers that were in that buyer pool that are no longer there.
And
so
I've seen
buyer pool is shrunk.
And I've seen price drops. People are dropping prices in that price range.
Correct.
Above 2.5, I feel like that's a whole different realm anyway. And those homes kind of do their own thing.
2.5?
2.5 and above.
Yeah, it's a totally different market.
Yeah. So if I hear what you're saying is we have a good floor.
Mm-hmm.
We could see some prices come down, but nothing significant. There's
Nothing significant.
Not a deal unless, it's like missing a kitchen or
Yeah. That needs a lot of work.
the roof.
Yeah, exactly. Which is, getting back to first-time home buyers, you've got to be open to those things.
Yeah.
If you are, you're going to have a lot more luck. You're going to have a lot more things to choose from. If you're willing to put a little sweat equity, we're talking about, going back and putting a little sweat equity into a home in order to have one.
Right.
But if you're willing to do that, you're going to have a lot more options.
Okay. I mean, I think that's a fair assessment. There's so many different angles we could take on that. I think from maybe you're not a first-time home buyer and you're just listening to the podcast, but investment properties, like to me, if I want to pay 7%, because typically it's a 1% markup on investment property loans, right?
At least,
7% for an investment property that's going to be a rental, like a long-term rental. That doesn't make sense to me. The only way you can make money on that, unless you're putting down a big chunk, which then I question that too, is the price has to keep going up. We've talked about this on prior podcasts. I don't see that price moving up. I think that the rentals are going to be the homes with a lot of hair on it and probably some sweat equity and some remodeling, the traditional format, right? But ultimately, I think it's vacation homes. I think that's where you want to be putting your money. You disagree?
I kind of disagree. I do.
So why do you think
the investment properties are a totally different beast than your home that you're living in?
I'm just looking at the ROI.
Well,
what's the S&P 500 going to be over the next 10 years versus a rental property going to get?
Well, are you looking at appreciation only, or are you looking at cash flow?
I'm looking at cash flow. I'm just saying at 7% interest, the cash flow, and there is a cap at what you can rent things out at, right?
Yeah, I mean, there's always a cap on any market. However, you've got so many
3-bedroom, 2-bath, $2,500 a month. Is that pretty standard?
Yeah. Okay. All right. So as long as you're, the interest rate that you're paying, as long as all the other factors that you're looking at with an investment, when we're talking investment properties, it's totally different than.
Yeah, I know. We just investment properties.
Say.
It's my podcast. We do everyone.
But you have appreciation, so you have built-in appreciation that you can kind of count on.
Right.
You're saying let's get back to reality and say that we're talking about 3-4% a year.
Right.
You've got unlocked appreciation, and that is, can you improve the value of the property by buying it and doing some improvements and getting creative with it?
Right.
So as they're unlocked appreciation, then you have depreciation. You get a tax benefit with investment properties.
Yeah.
You get a write-off.
Yeah.
And that can be significant.
Well, only if you don't give it up when you sell it. Only if you do a 1031
exchange.
Yeah,
then if you roll it over, that makes sense.
That does.
However, if you're in it for the long haul, if it's an investment, you always, you're in it for the long haul.
Yeah, you don't do this for 5 years and move on.
No, you don't. And then you've got the cash flow. So you've got multiple different channels of value or revenue on an investment property. And a lot of people get hung up on what does a cash flow?
Yeah.
That's all they look at. Is it positive cash flow? Yes or no?
Well, you do need positive cash flow, or else you're out of pocket every month.
Well, yeah, but if your appreciation is going to make that up, and the depreciation is going to make that up. So now let's talk about the internal rate of return.
Yeah. Yeah.
It's a different conversation, but you've got to think
is.
like an investor and not necessarily just someone that's buying a rental property for the cash flow.
Yeah.
That's all I'm saying.
But see, if I go down to the beach and I buy an overpriced rental,
No, if you pay overpriced,
well, they're all overpriced. They're always overpriced, it seems like.
According to who? The market? Because that's who determines the value of
I
the
know.
market.
I'm saying that more sarcastically. It's just, you're like, $500,000 for this? Like, where's the bedroom? It's a studio.
Yes.
Oh, it's a hotel room. That's what it is.
Yeah,
It's $500,000.
I know. It is.
And who rents these? Family of 5. I don't know who rents those yet, right?
Yeah.
But anyway, so I see it as I can adjust the rental. Like I can adjust faster to people paying more to go on vacation versus a long-term rental where I have to wait for a year or 2 years to be able to adjust the rent.
Exactly. Yeah.
And I can get some personal use out of it too.
Well, you can. But however, when you do short-term, you're talking about short-term
rentals. Yeah.
You have higher risk because your vacancy rate is high.
That's true.
So you've got that.
Yeah.
Right? Long-term rental, I'm going to put somebody in there for 12 months. At any given time over the next 5 years, I may have a vacancy for maybe 2 months a year, 1 month a year that I've got to budget in. 2% vacancy rate.
But if they damage your property, you keep their deposit. they damage my property, their insurance has got to pay for
Okay.
the immediate.
There's pluses
There's
and
pluses and
minuses.
minuses, yeah.
Right. And then, so I know, like at the beach, you're talking about the beach. I'm talking,
or beach
Alabama.
or nice mountains. Yeah.
Okay. Well, your vacancy rate there is probably more like 40%, 30 to 40%.
Yeah.
So
at least at the beach, you can get, well, you used to be able to get snowbirds. I don't know if they're letting them out anymore back in, but I think they let them out, but they don't let them, Canada doesn't let them back in. I think that's the problem.
Well, not all snowbirds are from Canada. There's some
people pouring across the Mexican border, and the Canadians don't even let their own citizens back into their own country. That's pretty funny.
It's pretty funny. It's a crazy world.
This is a crazy world. Okay, so Michaela, I asked all these questions, got figured out your plan, right? So here's what you're gonna do, Michaela.
You're gonna buy an investment.
You're gonna keep renting. You're gonna keep renting here. You're gonna buy a property where you want to retire someday. You're gonna rent it out, let someone else pay the mortgage, right? And then you have a paid off home at retirement, and then you just stop renting once you're here.
And that's called house hacking. House hacking. You buy a house and you fix it up, and you find a roommate,
right,
and have them pay your mortgage for you.
Right.
Hey,
that's
buy
right.
my little mountain house somewhere.
There you go. There you go. Just put it in a rental program and go visit it every now and then. Okay, so let's get back on topic, because Tommy, you and I could talk for hours.
Yes, we could.
Am I financially ready to buy a home? This is on our episode outline here. Here's the thing. Home purchase. First of all, let's go back to our old topic. Passive income. There is no passive income. Okay. I have a vacation rental property. There's nothing passive about that place. I don't think I've ever enjoyed it one time. Maybe one time, but I go up there, I fix stuff, clean out gutters. I do stuff, right? I'm also a busybody, so we'll handicap it a little bit there, but there is no passive rental income. I don't think there's such thing as passive income. I mean, maybe dividends from a company stock, but then there's also the anxiety that you own company stock. So, right? See what I'm saying?
I see what you're coming from.
But ultimately, my point is that you have to maintain a home. So it's kind of like buying the late model BMW, because you got to have a BMW, and then you get shocked when you go in and brakes are $5,000.
Yeah.
Right. It's like, you got to pay to play.
Yeah, and this goes back to your conversation of why are rents so much higher than your mortgage payment?
Right.
Well, because rents, you don't have those expenses to maintain the property.
Correct.
When you own a property, you do. You've got to budget that into your finances.
Or maybe you're really bad at maintaining stuff. That's another thing to think about.
Yeah. The homeowner now has the burden of maintaining that property.
We all have that neighbor, right? Just really bad at maintaining stuff.
Yes. Yeah. We have that neighbor.
Did that used to be you at your house?
What?
Have you always maintained your houses to the T?
Yeah, pretty much. I mean, I take a lot of pride in it.
I figured you would.
Yeah.
I know. You just kind of looked at me like, no, maybe that's me.
Well, I was thinking of my neighbors, and they were listening to this podcast. And I'm like, I gotta be careful here. I've got great neighbors now. We really do.
So yeah, I think it's you have to be ready to make this payment. I don't have a rule of thumb on that. I just know that you probably should budget $500 to $1,000 a month to do stuff around your house.
Yeah, I think you have two categories. You have expenses, monthly expenses, but then you also have long-term expenses, those capital expenditures that you got to plan for.
The new roof, driveway.
Correct.
Driveways are painful. I replaced mine a few years ago, and I spent so much money, I just want to sit in a lawn chair in the driveway just staring at it. Like,
that's a driveway. You got to be kidding me.
People drive by, like, nice driveway. Oh, thank you. That's an old man thing. Yeah. So you got to have some free cash flow. It's not that can you afford the mortgage. It's can you afford the mortgage and afford to pay for repairs and maintenance, right?
And I wish our industry did a better job at preparing people for the expenses of home ownership. And we really don't do that good of a job.
They need little stickers on the front of the doors like they do with appliances. Yeah. If you buy this washer, it's going to cost you $50 a year to operate it, right? They'd say the estimated cost of this house is, right? Because you don't hear about it at our homes, but you hear about it like movie stars, right? It costs them $50,000 a month to maintain the $50 million mansion. And you're like, oh my God, $50,000 a month. That's crazy. Yeah. But yeah, there's always something to do.
Yeah, there is.
If you want perfection, for sure.
There is. There is.
And what if you're not a DIY guy? I mean, what
Gotta
if you
be a DIY guy.
No, I mean, we've had prior employees here that were younger guys that I've just like, hey guys, we got this new desk and we got put together. And you would have thought I said, hey,
Yes.
let's reassemble the space shuttle and go to outer space.
Yes, I agree.
And I'm just standing there going, oh my God, like your future wife is going to hate you.
It's just a different era. It really is.
Don't know how to use the Allen wrench.
She just said Allen wrench.
Allen wrench. I'm impressed.
You're
That's awesome.
advanced. Yeah.
Yes.
You're advanced.
Being the only daughter to an engineer has its
Oh, well,
benefits.
there you go.
Ah,
There you go.
There you go. Yes. So you know the Phillips head and the flathead
Yes,
difference?
I do. Yep.
Wow.
Had to go through that because it's normally the son that's behind you handing you the wrong tool. So I was the daughter handing the wrong tool. So I
Right.
quickly learned.
Interesting.
I love it. I love it.
Now we know who's assembling desk around here going forward.
Yes.
Not to change the topic yet again, but
Okay, but no, they need these stickers. This house costs X amount to maintain.
Well, and I'm gonna blame HGTV, for a lot of that.
Chipping Joanna?
Yeah.
Don't bring them into
because
this.
everybody
What?
wants that house. And so we work with a lot of
Oh.
first-time home buyers, and that's
They walk
conceptually
in.
what they want. Well, that's what they're looking for.
Oh,
And we have to, unless their budget is $750,
yeah.
we have to bring them back to reality and say, okay, probably not going to get a perfectly maintained and beautifully updated home.
Right.
So let's have a little flexibility. And some folks don't like the DIY,
Yeah.
approach, and other people are perfectly fine with it. So
Yeah, if you want it the way you want it, you probably got to have $100,000 in your pocket, and then you got to buy the house.
Yeah.
And so that's a lot of money to save when you're young.
and that's another issue that we're running into is the expense of all these improvements have drastically gone up over
Yeah.
the last year and a half. So
Right.
most people are estimating way too low what it's going to cost to replace appliances and flooring and
Oh yeah,
paint.
I'm sure.
They're thinking, oh, I don't know, $3,000 for appliances. No,
That'd be your refrigerator on
yeah,
sale.
That's a sale. That's a scratch and dent
Right.
refrigerator right now. So those are the shocks that people are realizing right now. And so yeah, we have to work through all that. So once again, it's not getting easier.
I think the safe thing to do is really take Dave Ramsey's approach. You need to be debt free. You need to be out of the credit card debt, get rid of the student loans, get rid of clear the decks before you make that home purchase. But here's the kicker. I really want people to get a 15-year mortgage. I wish someone had told me get a 15-year mortgage.
Mm-hmm.
I have one now. Well, it's like 10, but when I refinanced when the rates were really low, I did a 10-year on one home, 15 on another, because you just save hundreds of thousands of dollars in interest. Hundreds of thousands of dollars in interest. It's just, if you can't afford the 15-year, maybe you just don't buy the house.
Yeah.
Or if you have a job that is somewhat volatile in income, you have good years, bad years, do the 30-year, but then make that auto payment to get it paid off in 15 years. You don't want to be house poor in the long run. But I wish someone had told me that. There is a little bit of an interest rate savings. It used to be a bigger difference between a 15 or a 3-year interest rate, but maybe it's only like a quarter point now. And we're in this weird interest rate environment right now too. So it changes rapidly and it changes daily, hourly sometimes.
Mm-hmm.
So I would encourage everyone to do a 15%, a 15-year mortgage. It's gonna be a little harder at 6 3/4 interest rate, but I would make that a goal. And every mortgage statement that you get, you're going to see a tick down in the mortgage principal balance. Not 30-year, it doesn't move much. You get to the end of the year and you're like, that's all I paid?
Yeah.
Right? So yeah, that'll save you 15 years of payments and save you, depending on the value of the home or the loan, $200-something thousand in interest. It's crazy.
Yeah. And I piggyback on that just a little bit. We talked about investments, like an investment property.
Right.
Your personal property for the majority of people is not an investment property.
Oh, no way.
not an investment
No.
property. So we work with a lot of folks that get that confused. We'll go out and we'll start working with them, and they're thinking it as if it's an investment property, and it's like, hang on, this is a lifestyle. You're doing this from an emotional standpoint, which is really why you buy a house, right?
As much money as I put into my primary home, I have to live 2 lifetimes to make the money back out of my.
So don't confuse the two.
Right.
Do not, we're always talking about, cannot confuse the two. It's two totally different approaches to real estate or a property.
I always tell people, when you remodel the kitchen, are you going to go based on what the market wants you to have in a kitchen? Or are you going to do a kitchen that you like?
Yeah.
And they're like, I'll build the way I want it.
Yeah.
Like, well, there you go. You may not like gray.
That's right.
Or it's not even gray anymore. It's like this light tannish color is the in color now.
Yeah.
No, your primary home is never an investment. I think some people get lucky. I mean, we have clients out on the West Coast that bought in Seattle. They bought a home, inherited a home that they bought from the family at market rate.
Okay.
And then that home was sold. They bought another home in West Seattle, and I think they paid like $600,000. 2 years later, I think they sold it for 1.2.
Okay.
Because of all the tech moving in.
Yeah.
So you hear stories like that. That is an investment at that point. They had to pay capital gains tax on that.
Well, in the last few years, even here locally, I mean, we've been spoiled. I mean, our appreciation has jumped through the roof. So it gets people thinking, holy smokes, this is an investment property. We're not going to see that appreciation year over year over year. We're just not. It's going to pull back, and it's pulling back right now. So anyways, we talk to people all the time about, don't get confused with your home that you're buying to live in as an investment property. And so we'll sit down and we'll talk with folks about what their must-haves are. Mm-hmm. And usually there's 3 to 5 must-haves that you have in your next property. And if there's 2 people involved with the purchase, we'll have them do it separately. And interestingly, they don't line up sometimes. So that's another conversation that we have to have.
Yeah.
So one of them usually is looking at it more of an investment, like it's got to be, I want a return, it's got to have this. It's got to have all the right things. And the other person is more like, I want a big backyard, I want some place for the kids to play. So it's kind of interesting, but it's a dynamic conversation that you have to have with clients.
Yeah.
So
you're going to have to, you're buying a place that, if you're having a family, you're buying a place that you're going to create memories in.
Mm-hmm. Yeah.
And the house we live in now, I don't know. I mean, to me, it's just an okay house. I don't love the house, is what it is. But I didn't buy it because I love the house. I bought it because the backyard's big.
Yeah.
And it's flat. And I remember standing there looking at it going, we only had one child, one on the way when we moved in. I'm thinking, I don't know what's going to happen in this backyard, but it's going to be cool.
It's got a putting green now.
It has a putting green now. That's right. But it was a football field for a while, and we would paint stripes, striped football field, like all the stripes. And sometimes we got creative with logos. And so we played backyard football. We had, there is one tree that gets in the way, but we do have backyard baseball set up. When they redid the front portico, they had a lot of stones left over, so we painted them white, and it just became like permanent bases until the lawn guys complained that they were running over them and messing up the lawnmowers. But it can be a makeshift baseball field. And then there's been multiple putting greens. We're on the second one now. The first one was real, and don't ever do that. Oh. It wasn't like real putting surface. It was just really tight Bermuda.
Yeah. And
so you could sort of putt. It was like the old videos of Arnold Palmer, and the ball would bobble back and forth as you putted it.
Yes.
That kind of lived its life. And then during COVID, we had nothing else to do, so we rented a Bobcat, and we put in our own green. Okay. Which is pretty cool.
Wow, that's pretty cool.
Driving the Bobcat was my favorite. I tore up the whole backyard, man. I had to replant all the grass after. Fortunately, we just have fescue, but. Yeah, it was fun. But again, memories.
My point is, this is why you buy a house.
That's why you buy a house.
That's why you're buying your primary residence.
A friend of mine bought up in Woodstock when nobody was buying Woodstock. He has like a little mini farm up there, right? Yeah. So it's he's building memories with gooses and geese or whatever they call them. And I should have done that, actually, looking back on it. But I didn't know that my daughter was going to do horses. So now it's ridiculous. No way I'm buying a mini farm.
Yeah.
But Yeah. So, you know, you have to think about those things. And ultimately, I think that's what you use those, what you want for the future as your motivation. That's why you got to get rid of, that's why you don't have Amex credit card debt at 29%. That's why you're eliminating that student loan. That's why you're maybe drive a car that you're not making a payment on. Maybe it's not the best car on the road, but you know what? Your goal is to buy a house. You know, if you're in your 20s, I'm talking to the younger kids now.
Yeah.
So, you know, use the thermometer on the refrigerator wall that, well, that doesn't work anymore because it's all this clean steel. But your thermometer up on some door somewhere, and you're shading in how much you've got for your goal, and you just charge ahead and saying, "This is what I want for my future. This is what I want for my family."
Yeah.
And you go and you save that down payment. Speaking of down payments, if you put down 10%, you're probably going to have an additional payment on your mortgage called PMI.
Correct.
So basically, the bank is concerned that if they have to repossess the home, or if there's a problem with the title, that, right, because it's mortgage insurance is what it is, right?
Well, I think that's, I don't know if that's separate or not. I think mortgage title insurance
Title
is title
insurance,
insurance.
that's true, but the bank takes, well, no, you buy that at closing, I think.
That's
It's
a
really
lump
cheap,
sum.
though. It's pretty cheap usually.
Well,
Well,
it's all
maybe,
relative.
maybe not
a
anymore.
couple $1,000.
I'm about to say, maybe not anymore.
There's a ratio. It's a,
but you're going to pay PMI until your house has at least
Correct.
20% equity in
that's
it.
built in every single month.
And some banks are going to turn that off at a certain point in the amortization schedule. Some banks will allow you to get your house reappraised for a few $100 to show that you have at least 20% equity. That payment will vary from bank to bank. I did not know this until many years ago when I was shopping. If I did something through the credit union, my PMI was like $35. And I used some local bank, got a quote from them, and theirs was going to be $300.
Yeah.
A huge difference.
Yeah.
And my understanding is, I'm not an expert on the PMI part, but there's two different choices, and the credit unions tend to go with one choice where the banks are doing something else. So maybe
credit unions
or something.
operate. You may know this more than I, but I know credit unions operate differently and under different rules than a bank.
True.
So
True.
that may have
I
something
feel
to
like
do
they
with it.
sell their mortgages to each other, though, but I don't know.
They do.
I just noticed that it was cheaper. So ultimately, you want to have 20% down if you can.
That's optimal.
If you can't, then maybe have a plan to accelerate those payments to get that PMI off, because that's almost money wasted, really. But in this market, if you're trying to get in, you get the 10% down, try to do a 15-year. That'll get rid of PMI really fast. You do a 15-year mortgage.
Correct.
Because you're
I'd have
paying-
to check with a mortgage
you're-
person.
but you're paying down so much faster.
I don't even know if you can get a PM. I don't even.
PMI 15
Yeah,
year.
I don't-
Think they force you into 30?
Probably. I don't know
Interesting.
that for a fact. That would be something to look into.
I don't know. We have connections. We can figure it out. Well, it's a whole other podcast.
It's only a phone call.
Well, the bottom line is 20% down, no other debt is really what you're looking for.
Yeah. And I might, just again on this mortgage conversation,
Yeah.
there's programs rolling out every single day, especially now with the rates increasing. More and more different programs are rolling out.
Yeah.
So,
And if you're a first time home buyer, which doesn't mean you have to be, this is the first time you ever bought your home. It just has to have been so long since you bought a home last, is my understanding. But if you're a first time home buyer, there's actually additional credits for that as well.
correct. Once again, different programs are rolling out all the time.
So this is why you don't go to your bank for a mortgage. You find a mortgage broker who understands the different different programs,
all the
that
different
are
options.
available.
So a broker will be able to show you all the different options
Yes.
that are out there. A bank has one option, and it's usually very narrow.
Right.
Their requirements to get qualified are typically higher than you would find with a broker.
Correct.
So I always encourage everybody to work with a mortgage broker.
Yep.
It's not a middleman. It's not an additional layer of expense. It's actually they have a much wider breadth of options for you.
And you have connections. We have connections. People can reach out to us. We're
Yes,
happy to tell
absolutely.
you who the good people are. How do you know you're not overpaying for a house? Is that even possible?
Well, it is. The easy, quick answer to that is most everybody that will be buying with a loan is going to get an appraisal. So that's your
True.
security blanket right there. So flashback 6 months ago when things were crazy and we heard all these stories about people paying $50,000, $60,000, $100,000 over asking.
Mm-hmm.
If it was built into the contract that you wrote, because you can waive this right However, if you got an appraisal contingency on the offer that you made, it's going to be contingent on the appraisal. So you have that security to come back to. Let's say you offered $400,000 for a house, and you feel like afterwards you have a little buyer remorse. You're like, holy smokes, I don't know if this thing's going to work. And the appraisal comes back at $350,000. Then you have to go back to the seller and you renegotiate the difference. Yeah, either you come back to the appraisal price, you pay the difference in cash, or you say, this isn't going to work for either party. You tear it up, you get your earnest money back, and you keep on moving on. So, that's the short answer. You're going to have an appraisal, somewhat type of an appraisal coming back and getting everybody back down to reality. What was crazy was that the appraisals wouldn't match. People would close anyway with additional cash. They were waiving the appraisal contingency. Yeah. We had to in order to win the house. That's crazy. If I had a buyer that had to buy a house, we would sit down with them and say, listen, here's the risk. If the appraisal doesn't match what you offered, are you willing to pay over and above what the appraised value is? Everybody was saying, yes, I'll pay 60 over. I'll pay 70 over. Right. I've lost 5 houses already. Yeah. I need a house. Right. So that's what was happening. That's another benefit to these higher interest rates in a little slower environment. I think you have time to think now. It's such healthier. It's so much healthier. I think it's great. It's that supply and demand balance that we were talking about earlier is coming more in balance. It was so imbalanced. Yeah. And it was unhealthy. Anybody that was out there over the last couple of years trying to buy a home felt it. It was not fun. Right. It really wasn't. So it's getting back to reality. We're just going to have to find out how much these rates really are going to affect that demand side. We have this whole YouTube channel. Did I mention that already? Tell me more. So a couple of things you can find in our podcast notes. Should I pay off my mortgage? How to leverage assets to buy a home. These are all different videos we've done on the YouTube channel, linked below. Also, episode 17, we did real estate with Tom Townsend. That was a long time ago. Tom, was it? Yeah. We're in episode 133 now. It's crazy. Wow. Episode 51, is there a looming real estate crash? We did that as well. Episode 9, all things mortgages with Mary Ansley Sutherland. That's a good one. Talking just generally about mortgages in general. Mary Ansley is not practicing right now, but we have a new mortgage broker we can refer you out to, or use Tom's. You can also find townrg.com. That's Townsend. Townsend Realty Group. Yes. Tom and his team would be happy to help you navigate this market with a purchase or a sale. Tom just sold my next door neighbor's house. Yes, I did. My next door neighbor. I didn't review any of their information or balance sheets. Didn't screen them. Is that legal? Maybe that's why you didn't offer. You sold in what? 2 days? 1 day? It was like a 3 day. 3 days. 3 days. 3 days full asking price. There's no better. This was just a couple weeks ago. So those situations are still occurring. Yeah. Now that was a beautiful home. All right. The owner needed to sell that home in order to get her life back, because she everything that came she took. She was a great homeowner. How about we go with that? Absolutely. There was not. She was a great neighbor too. But no, she needed to be free of the burden of home ownership. Yeah, she was ready for that. And move to a place that she could manage easier. Yeah, absolutely. And it's a beautiful home. So once again, we're getting, in our local market, we're getting back to the basics. Well, quality is going to sell any day. Quality and a beautiful home is going to sell. Right. So yeah, quality will move, I think, in any market, really. Yeah. But no, there's no testament to your skills other than your results, and that was very quick. Hopefully, it was quick. In a very quickly changing market. So we were very pleased. Yeah, I was very happy for her. Things in our street don't come up very often, so I knew that it would sell pretty quick. So yeah. All right. So we've got all this. Also helped your grandmother. Right? Oh, my mom. Oh, your mom. I'm sorry. Yeah, that's right. You saw my mom's house. That was in a couple of hours, wasn't it? Yeah, that was quick. That was in the middle of the mayhem. Yeah. You got multiple offers. Yeah. Yeah. Yeah, that was
I'm trying to forget
7
that
months
move,
ago.
man. I'm trying to forget that move. I know my mom listens to my podcast. Love you, Mom. But that was quite the undertaking.
It was great.
It's like,
and it worked out for her, right?
yeah,
She's doing
no,
great.
she is so happy now.
Yeah.
She's down in Bluffton, South Carolina, near my sister, who is in just off of Hilton Head on one of the little islands out there, Kawasi Island.
Mhm.
Is that right? No, not Kawasi. Anyway, I forgot the name of the island she's
Okay.
on. It's near Spring Island. They connect. But yeah, that was a crazy move. I mean, my mom lived in a 2-bedroom, 2-bath house or condo, and the deal was we hired a packer, and she kept saying, "There's a lot of stuff in here. There's a lot of stuff in here," and then I got the largest U-Haul truck you could possibly find. It was 26 foot, 24 foot.
Yeah.
And then I had a full busy day here running the global headquarters of Wiser Wealth Management, right? And I put my son in charge of supervising the movers. And he calls me like halfway through the day and he goes, "Dad, they filled up the first truck." I mean, we mean the first truck. They said they assumed there another truck was coming. I'm like, I can only drive one truck at a time. And so I had to run down and rent a whole nother truck. And my sister had to come up on a 24-hour turn. So they came up and we had to drive 2 trucks in the middle of the night.
Oh, wow.
And then I got there and I was like, "Mom, you got to like thin out."
I'm convinced U-Hauls are wrong though, because when
But
I
literally
moved,
on the side of the
It was
U-Haul, it
crazy.
says 3 rooms.
it does. Okay, and I got one for mine, and it
No,
was
it
for
said
a
5 rooms. It said 5
Mine
rooms.
said it was for a 2-bedroom apartment. I only had a 1-bedroom apartment worth of stuff, and I didn't
Yeah.
even have a lot of stuff because I had already taken my clothes and stuff separately. It
Yours
was
didn't
just
fit?
furniture, and it did not fit. I had to get my fiance Drew to literally bring his 4Runner, and we packed it down too. It was
wow.
like insane. I was like, this is
So
not
maybe
correct.
it's not my mom entirely. Maybe
no.
it's false advertising on
Yeah.
the side of U-Haul trucks.
Yeah.
I don't know. I'm
Who knows?
suspicious.
U-Haul doesn't know furniture anymore. Maybe I don't know.
I'm suspicious. All right,
That's
guys.
funny.
Good conversation. See you next time. Thanks for coming in, Tom.
Thank you. Appreciate it.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.